Good morning, everyone. Today I'm going to be talking about market conditions, trading conditions, and strategies that you use within each. There are six primary market conditions. They are the majority, that's what the majority of stocks are doing at any given time. Some market conditions are very long in terms of time frame. Some are very short. Velocity market conditions are the shortest of all, and the moderately uptrending market condition, which we are in right now, is the longest. However, in each of these market conditions, there's always going to be minor corrections or bounces or changes of things that are going on right now. Using the QQQ, we can see that the NASDAQ is very sideways, and it has a specific sideways pattern that it is holding within and moving sideways in. And this is an important part of the moderately uptrending market condition. There is nothing in this pattern to indicate that this is a topping formation. It is not a topping formation. We just had the flash crash of April. So we had a short-term correction suddenly turn into a big flash crash. For a couple of days. It rebounded. We know it's a flash crash because of how quickly the dark pools moved in, pushed price up, more selling the next day, pushed price up, and so on and so forth. I'm teaching my students about flash crash right now, and I wanted to share some things with you. This is a support level. You can see that it starts here, and it supports from the fundamental values of the majority of the stocks in the QQQ, which are 100 different companies. It is unfortunately not representative of new technology because it's a blended group of stocks nowadays, whereas in the 1980s, 90s, and into 2000 and into 2002, it was more of a high-tech technology index. It isn't that anymore, so it's more of a blend of things, but it still gives us information. We also have a support level right here from the lows of this area. As it corrects down, if it's an uptrending market condition, we would find the support at the highs rather than the lows. If it breaks through a certain level, which is 20% or greater for a bear market, and we're nowhere near that, even as we come down into here or down into here, we would be looking at the lower part of the support level. That's the one thing you need to remember is, where do you solidify your support levels? Is it above the consolidation or below? Well, it depends on the market condition. Trading conditions are the conditions that you're going to be trading within every single day that you trade. You may only trade once a week as a position trader, platform position, hold trader. You may be swing trading 2 or 3 times a week, or you may be an intraday trader, aka from your standpoint, day trader. But day trading is buying a stock one day and selling it the next day. It's EOD, FOD for end of day, first of day order type. And the pros use that. So we had an initial support level here. It has crashed through. So we're back down to this low. And what we need to do here is observe if this support that is here from this support level will hold or not. It should hold. There is no indication. This is not a topping formation. Not at this time. I don't see anything in the charts that would suggest it's a topping formation. There is some rotation move going on because a lot of the companies are using buybacks. I'll talk about that next week. And the buybacks cause price to move up beyond its fundamentals often because the bank of record is doing the buybacks. The corporation isn't doing it. They don't have anybody that's qualified as a trader to do that kind of highly sophisticated trading. But we have a nice sideways trend going on. It's a sideways trend because the lows and highs are fairly inconsistent, but it's still moving sideways. And we can see that there is some pro trader nudges and things going on in here, holding and supporting, as well as some sell side institution activity as well. What we don't have in here right now are buy side institutions. They're just waiting back. They're also lowering some inventories on a few stocks that they feel are not going to be as strong. They don't ever totally sell out of any of their 4,000 or 5,000 stocks that they hold at any given time, which is 2/3 of the whole entire U.S. market of stocks. But they do lower inventory. They do shift around things to get the optimal return on investment for their 401k and pension fund holders and for their long-term investors that are using their services. So they're very careful about what they do. So there's a pinging action that's going on. This dipped below, slightly below, pinged it back up, and it settled into here. Then it moved up, due mostly to buybacks, because you can see these gaps, and this is a velocity run because there's a gap in between each candle. And every time there's a gap in between each candle on the upside, that means it's a velocity run. Then we had a correction we wanted to check on and make sure that it would stop and hold at this green support level. We have volume that varies dramatically from day to day, below average volume, above average volume. We had above average volume on Friday of last week, which is a strong indication that there is support, enough people buying from the pro traders and others that will support this. And it was at this level right here again. So we see the strong intra level of support occurring as it pushes itself back up. Right today is a small candle pattern. It's a pretty volatile market because a lot of people are divided in their opinions on the retail side. Professional sides knows what they're doing, what they're going after, what they feel they can do, and they're predominantly to the upside. But for smaller funds managers who are retail and retail groups who are day traders, swing traders, platform position hold traders, long-term investors, foreign funds, sovereign funds, and so on, they are indecisive. Their groups are divided, which is extremely rare. So we have this more choppy to everybody calls it volatile, but it's actually more choppy sideways action than it is volatile. This is a volatile. This is a flash crash, and they're always volatile. Huge swings day over day, very huge, but quickly over. Where a bear market would not have that. It would have a steady, slow tricking down until the final capitulation. So you need to understand all this stuff and how it works and the dynamics of it, because a lot of people are saying that AI is in a bubble, and I kind of chuckle because if I look at all the charts that are AI driven or AI creators or AI developers, semiconductor industries, and so on, we just don't have a bubble. A bubble is an extreme deviated peak to the top that suddenly crashes, and we don't have that. So there may be some minor corrections or adjustments in some of the stocks, but nothing great is going on. The longer it holds in a sideways trend, the stronger the support level. So when it does break out, it can sustain and hold. This was a weaker pattern. This sideways pattern was developing, but it was weaker. So when the velocity run occurred and then it came back down, it remains in its sideways trend. This is a sideways trend. There are platforms, there are consolidations, there are resting day patterns. There's all kinds of patterns to learn based on what's going sideways. The market, if you look at it, moves sideways more of the time than it moves up. So you need to be aware of how to trade a market that is moving sideways. So the market condition is moderately uptrending. The trading condition is a sideways trend, and that you have to trade within the sideways trends or find sudden velocity runs or momentum runs poised to move up and then resettle back into a sideways correction. This takes time to learn, but it's important so that you can always have profits with your trading rather than trying to speculate or guess or get whipsawed out because your stop losses are too tight, your entries were incorrect, or that sort of thing. You need to understand that the market of the modern market structure, which is totally different than it was 5 years ago, it tends to go sideways more often than it ever has in the history of the stock market. There will be speculative runs, and they are awesome and they're dramatic, and there will be flash crashes if you know how to trade those that will make huge profits. But most of the time, you're going to be dealing with breakouts and different things that cause the stock to move with sudden velocity. This is a little velocity run right here because it doesn't have overlapping candles. Momentum has overlapping candles. So that's my topic for the day. I hope you understand a lot of this and study it in that detail. If you have any questions, I'll be happy to answer them. Thank you for joining me, and I hope you learn a lot, and I hope you trade wisely.